Good morning, everyone. Welcome to Contact's half-year results for the financial year 2017. Seated to my left is Graham Cockcroft, the CFO, and various people from our media and investor relations team hiding at the back in case I get stuck. Usual disclaimer, straight into the agenda. For a news and media briefing, there's no news. It's a continuation of a theme. Our strategy has not changed, and our role is to optimise our customer and generation businesses to continue to deliver strong cash flows. In a period of subdued demand, warm, wet weather, to have earnings go up is a pretty good performance in my view. Combination of factors drove that. Lower operating expenses, slightly higher mass market prices, more renewable energy. At the same time, we stayed safe and have a total recordable injury frequency rate at very low levels. And we also today issued our January operating statistics, which at the headline level are slightly better demand than last year, slightly better prices than last year, and lower cost of goods than last year. So January looks a bit better than last year as well. In terms of what does that mean for shareholders, we've kept our interim dividend stable at 11 cents. The last time it wasn't 11 cents was 2008, so you can see there's a bit of a pattern emerging there. We paid down some debt. We've been pretty clear that we would like to see our gearing ratio reduce. And we'll pay down debt in the second half as well. And we do have a predicted higher cash flow in the second half, largely as a result of dividend payment timings and capital cash flows. We also announced today a retail bond, normal refinancing activity, replacing a wholesale bond that expires in April. Nothing new on structural efficiency other than to say that with the current hydrology levels, the deferral of maintenance at TCC, it's unlikely that you will see us buy term gas for this year. We believe with our current contracts and stored gas that we can get through this winter without a need for term gas. We do see continued heightened retail competition, and we do see that structurally that's driving higher costs across the sector. From an outlook perspective, more of the same. Keep focusing on safety, customer advocacy and costs. We're on track to reduce our net debt to EBITDAF into the range we'd be more comfortable with, and then we'll have a conversation with the board and shareholders about perhaps changing the dividend policy. Page 4 is the detail in the numbers. The only two things to call out, one change we made to the treatment of costs associated with gas storage. So if you were doing a true period-on-period comparison, then you would see a $4 million, in the half, a $2 million lower EBITDA and a $3 million higher OPEX cost. We've changed that judgment. It provides greater transparency to tackle those costs. And from a cash flow perspective, operationally not much change in terms of cash flow generation, but this period we paid tax, and in the prior period we received a tax credit. So that's the big shift in tax. So what's going on in the market? We've seen low demand, wet weather. You can see it most starkly in the last quarter with demand significantly down. You can see the trend over the last 2 to 3 years. It's too early to call that a shift. I think it truly is a function of the current climate conditions. In terms of the retail electricity market, the Tier 1 retailers, so you might refer to the Tier 1 as being the big gentailers, Trustpower and perhaps Nova. Modest increase in energy prices, dwarfed by the increase in line cost prices. Switching remaining high. Tier 2 retailers benefiting from the benign conditions and winning most of the customer gains. And in fact, half of those have gone to a wholesale price product, which, of course, benefits from the current benign conditions. As the retail market develops, we develop how we think about it. And we think going forward, there'll be lots of innovation continuing in our retail business. That may require some capital, and therefore we've begun to think about these businesses separately. They run on different decision cycles, different capital cycles, and it would be very easy without transparency and discipline to overinvest in a retail business, which will need investment to benefit from data, digital and new technologies. So we're creating a transparency here, which, you know, we've been on for a while in contact, but this will certainly show these two businesses as very different looking businesses. And we believe that that transparency and our drive will see the performance continue to improve, and ultimately that'll be for the benefit of shareholders. In those two businesses, customer business is continuing its evolution from a commodity business to a low-cost commodity business to a business which is retailing in adjacencies and eventually to a retailer. We've made some foundational progress in this period with the move of all of our core systems to the cloud on the exit of infrastructure that Origin used to run for us. That will give us cost reduction opportunities and speed opportunities when serving customers. We had big improvements in retail operational performance. They're now going to be slower as we get much better at the majority of the activity in our retail business, including pleasingly a significant increase in NPS, or our Net Promoter Score, a measure of advocacy. We did lose customers over the period. I've mentioned high levels of competition, both at the Tier 1 and the Tier 2. Our focus is on value. We've discussed customer lifetime value before, and actually that business's margins improved over the period, even with a slight reduction in customer numbers. The generation business currently drives most of the cash flow. Strong earnings performance with an increase in renewable production. We didn't run TCC much, our discretionary gas plant, and that's unlikely to run much for the foreseeable future. We believe the market's reasonably well balanced, but with a high degree of hydro production at the moment, it's hard to see. But having said that, our portfolio allows us to be well positioned in any of those conditions, really. The generation team are on a continuous improvement programme that goes from improving production uptime through to cost reduction, and we would see that over time that you will see moderate reductions in cost, which, you know, over time will become meaningful to earnings. So with that, it's the introduction, and Graham will take you through a bit more of the detail.
Thanks very much, Dennis, and good morning, everybody. We start on page 13 with a few of the highlights for the period and numbers. As you've already seen, the EBITDAF profit of $261 million is a 3% improvement over the last year. Part of that improvement has arisen from our ability to reduce other operating expenses by $4 million year on year. If you do it on a like-for-like basis and making the adjustment that Dennis talked about earlier for the accounting changes for storage gas expenditure, it's actually a $7 million year-on-year improvement. Slide 14 reconciles the statutory and underlying profit measures between the first half of FY16 and the first half of FY17. You can see the underlying profit is up by $9 million, primarily as a result of the improvement in EBITDAF and the lower financing costs in the period. On slide 15, as we signalled back in November, we've now changed our segments from integrated energy and other, as they were, to customer and generation. We think this makes the business, as Dennis mentioned, a lot clearer and easier to manage. And to make the segment results more meaningful, we've introduced a transfer price between the segments that recognises the value of energy sold by generation and purchased by customer. We calculate the transfer prices for mass market and for commercial industrial segments, and the difference there you can see in the chart. That's really just the shape of residential demand during the winter. So the chart shows the inter-segment transfer price for both markets for the last 3 years. Turning to the results in the half, page 16 breaks out the EBITDAF movements in the two segments. Customer segment was up $6 million as the LPG business performed well. We were able to reduce our operating costs. While mass market volumes were down, the reduction in cost of electricity purchases reduced the negative effect of this on customer. And for the generation business, the $10 million reduction in the cost of energy was offset by lower sales to the customer business. I think this really highlights two of the major differences arising from the introduction of the transfer price. First, the volume risk is now shared between customer and generation, rather than simply falling on netback, as it used to be within the integrated energy segment. And secondly, the wholesale price risk sits with generation, while the retail margin price risk sits with customer. And we believe that this allocation of risk will help each business focus on the right issues for that business. The next two slides cover the segment performance in a little bit more detail. Firstly, for customer, I think the key messages to take from this slide on the customer business are the fact that mass market volumes were down, primarily on the back of lower usage per customer. Mass market unit prices held up for the first time in a while, which clearly is very pleasing for us. C&I volumes were up, but prices were down as they followed the ASX. The LPG business continues to go well, and we're continuing to make progress on reducing our operating costs. Similarly, on page 18 for generation, the key messages there, I think, are that the healthy hydro conditions enabled us to reduce our thermal running, but also reduced our merchant sales. Geothermal volumes were down on prior year as a result of the extended outage at Te Mihi. And the benefits from closing Otahu are now coming through the financials with lower operating and gas transmission costs. And following last year's impairment of inventory gas, we also now have lower unit gas costs. Turning to OPEX and CAPEX on page 19, as is clear from this discussion today, clearly OPEX is a big focus for us, and we're clearly focused on reducing those other operating expenses, which were down $4 million half on half. As a reminder, in FY16, other OPEX was $16 million lower than it had been for the full year of 15. So clearly, we're continuing to make progress on reducing other OPEX. On CAPEX, FY17 is tracking well, with the wet year enabling us to defer the major maintenance at TCC out of FY17. To balance that and to balance activity in that year of 18, we've brought some work forward into FY17. So that in net, the new guidance for FY17 is now about $10 million less than we provided at the full year. Longer term, CAPEX of $70 to $80 million per annum is unchanged from the full year results. Slide 20 takes us through the free cash flow situation. We use free cash flow as a key metric as it clearly shows how much cash we have available to fund growth CAPEX, dividends and pay down debt. Free cash flow in the half was $62 million down on the first half of FY16. Operating cash flow was $52 million lower, primarily as a result of the higher tax paid and less favourable working capital movements. You can see we received a tax refund in the first half of 16, which is the result of a combination of things, managing Origin's exit and the closure of Otahu. Our working capital was impacted by the lower thermal generation, reducing the use of stored gas, and the one-off benefit of collecting late bills in the first half of FY16. Slide 21. We've used this slide before, but I think it's worth repeating as we're frequently asked about our distribution policy, our balance sheet targets, and how we think about growth. And this slide puts it all on one page. Free cash flow is a key metric for us, represents how effectively we're managing the business given the current asset base. For the balance sheet and given the nature of our operational financial risks, we want to maintain an investment-grade credit rating. To do this, we target a net debt to EBITDA ratio within the 2.6 to 3 range under S&P's calculations. Clearly, the ordinary dividend is also a priority for us and our shareholders, and we've maintained it at a level above 100% of underlying profit for the last 2 years. Beyond that, we have some choices. and we're always looking for ways in which we can apply our capabilities in order to grow the business. But to the extent that we can't find any growth investments that meet our criteria, then we'll look to distribute cash to shareholders in the most tax-efficient manner that we can, as we've done either as special dividends or through buybacks. Slide 22 addresses the use of free cash flow in this half. As Dennis mentioned, the board has decided to pay an interim cash dividend for FY17 of 11 cents per share, in line with last year. As we've said at recent results announcements, the payment of a fully imputed special dividend in June 15 that predated Origin's exit essentially eliminated all the imputation credits we had at the time. And since then, we've been able to accumulate some imputation credits, but not yet enough to fully impute the dividend. So this distribution of 11 cents per share will be imputed to 8 cents per share, or 72% of the dividend. And as the chart shows, beyond the dividend, the majority of the remaining cash flow was applied to reducing the outstanding debt. We reduced the debt by $21 million during the half and expect to make further reductions this half. In line with the financial framework, we're targeting a net debt to EBITDA ratio of 2.6 to 3, and we expect to be in that range within this calendar year. As for the dividend policy, we expect to be reviewing the policy with the board during the next 6 months and should have more news for you at the full year results in August. With that, I'll hand you back to Dennis.
A fairly uneventful period. Lots going on in the market. Continuation of a strategy for us. So pretty pleasing that in a competitive market we are turning that operational performance into value with slightly higher earnings and some debt repayments. We continue to focus on growing our capability in retail. We've invested heavily in systems, and we think that over time we will be able to extend into adjacencies and move from that commodity retailer to metailer. But we think that'll likely be slow. The new technologies, in our view, will take time to develop. At the centralised energy production level, there's no real need for new generation. Tiwai exit still remains a risk, but with increasing clarity on transmission and also the reduction over time of some of our competitors' thermal fuel purchases, we see Tiwai becoming increasingly manageable if it were to exit. Having said that, it looks cash flow positive to us. Our plan is to keep doing what we're doing. Quality portfolio of long life generation assets, increased capability in retailing, driving through a continuous improvement programme for ultimately increased returns to shareholders. So given the market environment, in my view, I'm a pleased 6 months performance. And with that, I'll go to questions.